Hey y'all, it's Chris with Anderson Business Group. Today I want to explain where money is made. Not just making money in the marketplace, but where it is actually made. How our money is created in the marketplace. Right now we are on what's called fractional reserve banking. Fractional reserve banking is a way that our banks take the money that we deposit and in turn lend it out to others. We would think a lot of people believe that when you deposit $1, there is $1 there, a 1-to-1 ratio. That is not true. Until 2020, during the pandemic, your dollar in was worth 0.1 of a fraction. So 1/10, let's say. It was a 1 to 1/10 ratio. In turn, the bank, for every dollar that you would deposit, was allowed to lend out 9/10 of it, or 90 cents. So let's say that you put $100 into a savings account. That bank until 2022 would have to hold on to $10. Then out of the $100, they could lend out to someone else $90, thus creating your $100, saying it's $190 now. Let's say the individual that took the $90, reinvested it, and put it back into a bank. Then at that point, that $90 until 2020, 9 of it would be held onto, and the remainder of the $81 would be created income, made up money. So $271 was created was showing on the books, $171 just magically created out of your $100 deposit. And this would continue on. So imagine this in the millions, in the billions. This would just continue to put zeros there. This is how our current banking system works. Why do we do this? This allows our economy and our markets to continue to grow. It allows us to borrow money and reinvest it into housing, into vehicles, into businesses. This is how our money system is creating inflation. This is one of the factors of inflation. When you go to the store and you get a dozen eggs, and they used to be $1.99 and now they're $6, $7, $8, even in California, I believe it's $10 for a dozen eggs right now. This is why. This is one of the reasons why. The reason why the federal government allows this, though, is in theory, it allows us to continue to buy and grow and see our economy go upward. In the 2008 and earlier, when we saw housing crises and the too big to fail banks, they did not have the capital. They were reinvesting more back into the market than what they were holding on to. Now, in today's world, your $1, according to the federal government, has a ratio of 1 to 0. Banks do not have to hold on to your income that you put in any longer. So if you put $100 in, they're able to turn around and put your $100 back out into the market, showing a deposit total of $200, and then so on and so forth. The opposite of this is called full reserve banking. That is where your dollar is put in and it's not lended back out. $1 in is $1 in. You can go back to the bank and say, hey, I want my money. I got 100,000 in there, and they have that on hand. Right now, if a large portion, not even 100%, but a large portion of the populace would go to their bank at one point and say, hey, I want all my cash, they would not be able to do that. Our banks would fail. But this is what props up our economy, okay? Now, under, I believe it was Richard Nixon, took us off of the gold standard. This is a separate issue than this, but it used to be a bar of gold was worth X amount of dollars. The government could not say that bar of gold was worth more than that. In today's environment, we are basically creating money out of ones and zeros. They're make-believe. So even before we deposit the money, there is no true asset that you can go to the government and say, here's $100, give me something back in return. It is not there. Understanding this concept will allow you to realize how money works, okay? So what's the solution? I take my money and I put it under my mattress? No, not at all. In banking, let's say you're getting 0.01% interest on a savings account. Right now, money markets are paying over 5% back to the depositors. So where the bank is making money, you can make money as well. Take your money and don't just put it into a savings account, a rainy day fund. That is very important to have. I recommend 3 to 6 months of reserve so that you can continue life if there's a large event that happens, an emergency fund. But at the same time, make your money work for you. Once you hit that amount of your emergency fund to where you feel comfortable, start investing into the marketplace, buying stocks, bonds, CDs, putting money into a money market, high yield accounts. Those are typically through like credit unions. You can find higher yield accounts. So look at how your money can work for you. Don't just allow the banks to make the money to where, yes, they're paying you 0.01% on your savings account, but you know what? They're out there offering that same money, let's say $90 out of the 100 you put in, and they're charging the next borrower of that 18.99%, you know? So now they're making a higher profit of 18.98% off of you. It's your money. Utilize it smart. Buy tangible assets, real estate, things like that. Put it into the stock market. Yes, it is a higher chance of failure, but you know what? There's a higher chance of success as well. Understanding how money works is so important, and I hope this helps you. Have a great one, y'all.